So, welcome everyone. Excited to have you join us today, whether you're live, listening to the recording, podcast, video. I'm Scott Oeth, financial advisor with Cahill Financial Advisors, and we've got some great team of special guests here from Vanguard to talk about markets, the economy, a bit about the company, Vanguard itself, and very excited to have this conversation here. So one thing I always have to mention up front to keep our compliance department happy, we're just having a general conversation here, sharing thoughts and outlook. Nothing that we discuss here should be taken as individualized, specific advice. Please, seek your own expert counsel on this, do your own research. Feel free to give me a call at the office to talk about how this might apply to your situation. So general discussion, but I think it's going to be a great one. The other thing I should mention is we are completely independent parties. I operate as an independent fee-only financial advisor. I'm not an employee or a rep or agent of Vanguard. There's no financial tie and vice versa. So we're each operating as our own independent parties here. But that said, I'm very excited that John, my connection, my primary contact internally at Vanguard, has helped me bring in these great special guest here. My view, what I do with my work with clients is very, very broad. I think about this stuff all the time, but it's taxes, it's insurance, it's estate planning, it's philanthropy, it's real estate decisions, sending kids to college, whole gamut of things that touch people's financial lives. In addition to, yes, investments and economics. That's a big part of it. That's kind of the engine driving this financial planning car. But I absolutely know where to go to get more depth and more focused research and specific thoughts in any of those areas, and specific in investments and economics. And Vanguard, very unique company, started with a very unique approach compared to the classic Wall Street models. And going way back, I feel like I was very lucky in college. I had some finance professors that spent quite a bit of time talking about efficient market hypothesis and the index approach to investing. And I think I'm okay to say that my very first personal investments with my own money were a check where I wrote out an envelope, probably out of Money Magazine, and with little savings I had from my first year of work after college back in 1995, sent it into Vanguard. So like I say, we work with a number of companies, but yours is one that have held in high regard for a long time for a number of reasons. So with that, maybe I'll start by John. John Lord is, like I mentioned, my primary internal contact at Vanguard, and has been very helpful over the years. John, maybe first, you want to introduce a special guest that you've helped arranged for us for this call?
Yeah, so thank you, Scott, for hosting us. Your kind words about Vanguard mean a lot, and I'm happy to explain why Vanguard is unique. But before jumping into that, I am thrilled to be introducing Ryan Zala and Aswari Saeed. Both work in our investment strategy group. And what that means is they are among the smartest folks at Vanguard, specifically on economics and investments. So you will be getting really, really world-class investment overviews, outlooks, and insights. Um, Ryan's an investment strategist, and Aswari is a senior economist. So I am lucky to be sharing the room with them as well as Scott. And I'm the relationship contact for Scott, like you mentioned.
Great. Yeah, and I mean, and that's saying something, because at this point, Vanguard is certainly one of the largest, if not the largest. I mean, you're in the top five. Where's Vanguard sit in terms of asset managers globally? I mean, really one of the largest in the world, right?
Yeah, so we are currently the second largest global asset manager at around $8 trillion asset management. What that means to us is a lot of folks are trusting us with their assets, and that's not something that we take lightly. We take a lot of pride in the stewardship of managing those assets.
Yeah. So along with that, John, can you give us just a quick maybe history of the company, its founding, the philosophy, and what makes Vanguard special?
Yeah, so Vanguard is unique. I'll first talk about how we were founded and then what makes us unique. So first, John Bogle, who many people know, has founded Vanguard about 50 or so years ago with the goal in mind of improving investor outcomes for everyone. So he designed Vanguard very uniquely, where he didn't own it all himself. He didn't make it a publicly traded company. He chose to design Vanguard, very unique ownership structure. And that ownership structure is that the Vanguard funds own Vanguard. So as an investor, you own the Vanguard funds, you own Vanguard. So we're here today as your employees. And it's cool for us to be able to say, hey, we're having a webinar with our owners and the folks that own our company. Um, so that's a little bit about how we're unique. And I could share maybe some more about what that translates to and how we operate, how we manage.
Yeah, absolutely. I mean, that is such a unique structure. There's a lot of great investment firms out there doing good things, but I think most people will recognize, when you're publicly traded, you have outside shareholders, you have layers of management, you have board of directors, you have people looking for earnings reports quarterly. It can put pressure on the agenda internally in terms of the approach, the products that are being developed, the messaging. And so I think that really is a key point, a unique differentiator in the business jargon of the day. But yeah, what else do you have for us, John?
Yeah, I mean, you hit the nail on the head there, Scott. Vanguard is unique. There is no company quite like us. And when we make decisions, whether it be a business decision to invest in a certain area, a decision to open, close, launch, or revise an existing fund or ETF, we do so with you in mind, with you, the investor, and all of our investors at mind. It's even funny, I talk about big decisions like fund launches or strategic initiatives, but even the smallest decisions, we keep in mind the investor, our owner. For example, the other week, one of my colleagues in the office was printing out a PowerPoint deck that they're going to use later, and they printed it in color. Someone went up to them and just said, does that slide deck need to be in color? It could have been in black and white, right? That would have saved the investors money. So
Oh,
that's obviously a small example, but it just goes to show how often we think about everything we do and how much you as the investor are there in how we operate, how we think, and the decisions we make. So one thing you should take away is that you don't have to worry about Vanguard looking out for anyone other than you. We
mhm.
are aligned. We are acting in your best interest because it's how we're designed.
That's great. So, out of all the work Vanguard does with this tremendous, huge company, one piece always catches my eye, and that's this study on advisors alpha. And I find this very interesting because you talk about the structure. I mean, Vanguard, the mission, the different approach, really the founding of, the large part of index philosophy, being owned by the funds, by the shareholders, very do-it-yourself type roots, I would say. It's kind of the home improvement store of investing if you went back 50 years ago compared to the brokerage driven type model. But you've been doing this study for a number of years now called Advisors Alpha, studying the role of a financial advisor. And I wouldn't bring it up, obviously, if it wasn't shining a positive light on the potential benefits of working with a financial advisor. But could you tell us a bit about that, John? Maybe the update. I think we talked about that maybe 2 years ago in one of these sessions. But what's the outcome of this study?
Yeah. So, Scott, it's an awesome study. It's a study we've been doing for the past 20 or so years that has really caught the eyes of a lot of people. And I'll share why. It actually goes back to our mission, kind of what we talked about earlier. The mission of Vanguard is to take a stand for all investors, to treat them fairly, and to give them the best chance of investment success. Key word there is all investors. When we think about giving all investors the best chance for investment success, we believe firmly that the best chance for your investment success is through working with a financial advisor. Financial advisors are there to make sure you're making the right decisions, to think about all the things that you might not be thinking about or might not even know to think about. So when we thought about, well, how can we achieve that mission? Financial advisors play a major part in that. So the research we did in the study is what we call advisors alpha. So the additional return that you get from working with an advisor, we've done research on and we've been able to actually quantify. So we quantified the difference versus doing it yourself, like the home improvement store, doing it yourself versus working with an advisor. Annualized can be around 3%. And that's significant. 3% difference in portfolio returns and your outcomes because you chose to work with the financial advisor. So we have been preaching to the choir. Financial advisors are extremely important. And one of the things that, as we updated the research on, we've thought about has gained increasing significance is behavioral coaching. So this may be something that you might not think about, but whenever you're about to make a decision, having a professional who has helped others and can think objectively and clearly about that, help guide you and help make sure you're making the right decision is extremely important and makes up about 2 of the 3% difference in that advisor's alpha. An example, or Scott, you want to jump in?
Well, no, I mean, it's first of all, I hear 3%. I'm a bit of a skeptic, even though I'm obviously a big fan of the work that a good financial advisor can do and the benefit they can add. But it is so true. I mean, sure, when you look at something like tax planning, it's very apparent there's real dollars to be had there, or gaining efficiency in your insurance coverage, or any number of areas. But just that piece, when you're talking about the coaching of this year, I've had two different people, pick up the phone and give me a call, and they're curious about what it'd be like working together. But they both said something like, "Well, I don't know if I want to pay you just to pick mutual funds." And like, okay, there's so much more to it to that. First of all, on the financial planning side. But in both cases, when talking to them, so, well, how have you been going about making your investment decisions? They'll cite, watching this channel and reading this blog or their favorite book. That's all wonderful. But then you get down to it, in both cases, they were largely sitting in cash and have been for years, essentially paralyzed. And so, okay, can I pick better investments than a monkey throwing, darts at the stock pages of the Wall Street Journal? It depends on the year, maybe, but that behavioral coaching, without a doubt, I mean, I've seen it over the course of, over a 25-year career here. It is real. And there's a big difference between analytically understanding something. It's not about necessarily how smart you are. There's a huge amount of temperament and process and conviction, and maybe being a step removed from those big decisions, which for a lot of people are so hard to act on with their own money. It can be paralyzing.
Exactly. It's those big decisions that you make that you want to make sure you're making the right decision. So working with a professional makes sense. I can share a quick personal story. Back in 2008, my parents are both teachers, and they built up savings, they worked hard, they owned a house, they were frugal. And in 2008, when the entire world seemed like it was going to end, my mom was afraid. She was pressing the panic button. She was saying, "We have to sell. Everything's everything's broken. This is all broken. We need to sell what we can." And my dad and my parents' financial advisor sat her down and explained, "This is temporary. We need to remember our goals for these assets are more long term, and we can tolerate this risk and this volatility." And because of that conversation and because of working with the financial advisor, my parents are in much, much better shape. And they're both starting to look at the classroom and saying, "All right, well, maybe it's time for us to retire. We've done our time. It's great working with kids, but we're getting older." And they can have that option because they made the right decision back in 2008 with the help of their financial advisor.
Standing. It's a great story, John. Well, thanks for sharing, and thanks for sharing the update there. I know, I think people watching are going to be very interested to hear what the think tank internally is thinking about the big picture, what's happening in the economy, what's happening globally. We've had so much in the news, as always. It's kind of a repeat cycle, but there's a lot of concerning news out there, and people wondering where's this leading to in terms of economics, and then filter that down to actionable investments and where I actually put the dollars. And so maybe can you lead us off on the tour there? I know you have some prepared slides and swearing.
Yeah, thank you, Scott. And first of all, just wanted to, thank you for having us here on the call today. It's always great to come and talk to our end clients about, what do we see going forward. And it's not just about just specific asset recommendation, but talk about bigger picture, macroeconomics, what are we seeing there? And of course, Ryan is also here with us on the call to talk about asset allocation, or at least what do we see in terms of returns over the longer term. So I guess my goal here today would be to go through the economic section. What's our outlook for the US? We'll touch a little bit about on global economies in general as well, and then we'll dive a little bit deeper into the US and talk about that, right? So I have a couple of slides here that I'm planning to share.
Well, while you're
And
pulling those up, I just have to mention when I was looking over your bio, I noticed that one of your two master's degrees in economics was from the University of Wisconsin, and Madison's my hometown. My high school is just about a half mile up the road from the campus, and so
oh, really? Oh,
yeah.
it's
So I
beautiful.
know
It's a
you're
beautiful
smart. Yeah.
place. Thank you. Thank you. It's a beautiful place. I do definitely miss Madison quite a bit.
Mhm.
Maybe I can make it, this fall sometime.
Yeah.
But super cold in the winter, so I would avoid it
Yeah.
then.
Fall's a wonderful time there for sure.
For sure. Great. So, yeah, I think in terms of the economic section, I think it's very important to maybe focus in on what's the key question that we're all thinking about right now. And, how can we broach that topic without talking about the Fed and what's next for the Fed? So, whole of last year, a large part of this year as well has just been the Fed battling inflation, trying to get inflation back under control. Many of us will say that yes, this war is partially won. We are back from 9% inflation to 3, somewhere around that, at least in terms of headlines or core. But I think we think that there is still a second half part of this battle that remains. And my hope is that through today's discussion, I sort of answer the question of the why behind that, of like why do we think the Fed would still need to be a bit more hawkish as we head into the second half of this year and even early next year. And there is still some, we still have somewhat of a guarded view when we think about inflation and how quickly it can get back to 2%. But before getting to, sort of looking ahead, it's important, I think, to also look back and revisit, what has happened over the last few years that has driven us to today. And the way I generally talk about this with clients is I say, hey, it's probably a riveting four-part book series almost, where the first part is the pandemic, right? Who could forget forced business closures, just the extreme shock to the economy, not just, I mean, not even talking about the health and the shock in terms of, healthcare, etc., in terms of what families went through. Even economically, it was a great shock globally. In the US here, we reached unemployment rates at the peak of 14% during that time. So it was quite a unforeseen environment at that point of time. The second part of that series would be stimulus, right? Essentially, once you have shut down businesses, what the governments and policymakers had to do across the world was how do we bridge the gap? How do we make sure that people are still, you know, comfortable or at least have the money in their pockets to spend to sustain their livelihood while we're shutting down businesses? And the result of that was extensive fiscal and monetary policy support. Here in the US, close to $5 trillion were pumped into the economy to help us sustain that time period, right? And the third part of that series, as we've been living through that right now, is inflation, right? So of course, we had this huge shock in response to which we had fiscal and monetary policy stimulus. But this was happening at a time when we were also going through large supply shocks. So think of an environment where people still have some excess savings. They also have some, payments in the forms of fiscal stimulus from the government, and they are willing to go out there and spend it, right? But while they are out there spending it, they realize there isn't enough products on the shelves. That's because the economy as a whole was going through a global supply shock. So I don't know how many of us can remember back the whole shipping container shortage that had, lines of ships lined up outside the Los Angeles ports, or, essentially containers that were left at the ports in China, which there was no way of for us to get them back. So it was a huge global supply shock at a time when demand was essentially still quite high, and the end result of that was really high inflation, right? I think the poster child of that supply chain shock is used car prices, which at one point of time were increasing by 40% month on month. And that's coming from a sector that's usually seeing falling prices on a month on month basis. So that brings me to the fourth part, and hopefully the closing chapter of this entire series, which is central banks and the battle towards 2% inflation, right? So now the hope is that once you've gone through these series of shocks, I almost forgot to mention Russia and Ukraine, but also that was also a big shock that the economy went through last year. But now the closing chapter of that is going to be how do we get back to 2% inflation? And we think, the bottom line is we have one part of the way towards that 2% target. There's no doubt inflation is heading in the right direction, but the move from 3 to 2% inflation is going to be not as straightforward as many believe. We do see inflation falling towards 2% by end of next year here in the US, but upside risks do remain to some extent.
I have a question if I can jump in for a moment. Is 2% critical? Why is 2% important? I mean, if we look back over the last 100 years in the US, aren't we really something more like 3%? And I'm sure it depends on the starting point, and whether you're including Great Depression or not, and those types of things. But any thoughts on that?
Yeah, of course. And I think when you look back at the sort of archived documents of the Federal Reserve, their own discussion around, hey, what's the inflation target we should have?
Yeah.
There is this exact discussion of like, what's that level that we should target inflation at? And I think you point this out rightly, right? Are we moving in an environment where maybe 2% or even higher than that is an acceptable target? So let me first discuss about like why we ended up at 2% before. So based on just prior, you could say analysis or what, historical economic analysis tells us is that you need certain amount of inflation in the economy to prevent it from getting into a deflationary trap, right? And that's essentially what's more problematic. And what they found was 2% was essentially high enough to prevent that from happening in a persistent manner. So they essentially settled on 2%. The other factor that was important now, could that target have been 3%? Yes, it could have, and the economy could have settled down on that. I think what the Federal Reserve at the end of the day is concerned about is inflation certainty more than the level at which inflation settles on, right? So they want to make sure that we have less uncertainty about inflation going forward instead of where do we end up? Is it 2 or 3%? It might as well be that in the future we start pushing towards higher interest rate, and that goes into the entire discussion. A lot of people might have seen this on the news about R star, right? That elusive R star neutral rate estimate that is based on where inflation expectations are and where real interest rates of the economy is, and that would argue for maybe higher inflation as well in the future. I think the jury is still out on what that exact level needs to be. One thing is sure, and maybe the sort of underlying thread in all this is whatever the inflation target, we need to have the economy anchored on that target. So you don't need to be moving that 2 to 3% frequently. We need to have enough confidence in the monetary authority. The people need to have sort of confidence in the monetary authority that inflation will be predictable in the future. So I think
Yeah,
that's the main focus here instead of the actual
great.
target itself. Yeah. So that's a good segue into the actual discussion, right? So in terms of an outlook, I think first we'll talk about global growth. So we'll talk about, you know, where do we see the base case of global growth? I think the bottom line here is we do see inflation falling, but that's going to come at a cost of lowering growth down the line. Now, of course, the timing of that, which economy goes into recession first versus another is slightly different based on the underlying factors for each of them. The second part of this outlook would be on policy and interest rates. So once we've talked about, what's actually driving the slowdown, of course, we have to look at the immense amount of monetary policy tightening that's gone into the system. So eventually that does bear fruit. And that policy interest rate, once you start to see that recession, the next question is, how do they now moderate back to neutral policy stance and going forward? We think this path is going to be challenging, right? Here for the Fed, for example, we think that they're close to their terminal rate, if not at it already. We are at 5.25 to 5.5%. That's the highest it's been in the last 22 years. And from this point onwards, I think the risks are more balanced on, whether rates move higher or lower from here, and it hinges critically on what happens to inflation going forward. So we'll talk a little bit about that too. And then I'll end off the discussion on recession risk, right? Because how can we end an economic discussion without talking about recession risk down the line? So we do see the economy slowing down. As some of you might remember, at the start of this year, we had seen that slowdown to be this year. But since then, given the resilience in the US economy, we have moved that time frame back into 2024. So now we expect that recession to be sometime towards the later part of 2024. And of course, we'll go into the reasons leading up to that change as well, right? So, with that, maybe let's begin with the first section, which is on global growth and what do we see for the US. But before going to US, let's talk a little bit about across the world. What do we see, right? So, growth doesn't look that good across the world, right? If you look at the top left hand side of this slide, you see the GDP growth estimates by Vanguard for US, Euro area, UK, and China. As you can see, for both EU and UK, our growth numbers are quite low, and we expect them to be, for UK, for Euro area, for example, they were in a technical recession sometime earlier this year, and we expect growth to be quite sluggish for the rest of this year as well. They're going through some of the same issues that US had with high inflation, but they felt more of a shock from energy prices. So, inflation has been harder to control in the euro area as well. Similarly, for the UK, growth remains quite sluggish, and our expectation is that they will be in a recession by the end of this year. All of this, unfortunately, is happening in an environment where inflation is still rising for them. So, unlike the US, where inflation is now heading down, in UK and Europe, inflation is still on the upside. And so, what
Mm.
that means is monetary policy will still remain quite tight, which ultimately means that this recession will be unavoidable to some extent for these regions. I think China, again, an outlier at the start of the year, because when we were seeing the sort of China come out of its lockdown, the expectation was there's going to be this large recovery that's going to help all of the regions sort of, bump up their growth to some extent. But that hope has been, somewhat disappointed by the fact that we have seen China growth also remain quite sluggish as we head into next year. One of the main reasons for that is the private sector, right? So the private sector has remained quite slow in terms of consumption, growth, investment. And we have looked at a variety of reasons of what's driving that. One of the main factor being business sentiment, right? So if you've had a number of business closures, reopenings, and have them for for a couple of years, that has really eroded the confidence that the private sector has in policymakers and has led to lower investment and growth for this. So the growth outlook for China also is biased somewhat on the downside from this point onwards. I would, in fact, argue that the outlier in all of this is the US, with much more resilient growth. We had began this year thinking that US growth would be somewhat lower, so around consensus of 0.7, but we have revised those growth numbers up to about closer to trend of 1.8%. And the reason for that is the sort of resilience you're still seeing in the consumer here in the US, right? So there are a couple of reasons why we still have a very resilient consumer. The first one, I think, first reason for that is well shown in the chart on the very left hand side here. So this looks at the excess saving people still have that can sustain consumption for a number of months going forward, despite the high interest rates that we are seeing. So based on our analysis, we think people still have about 12 months of excess savings, despite the high interest rates, despite the contractionary environment, and would be willing to spend down on that saving going forward, which keeps consumption growing at a certain pace.
That's very interesting. You talk about resiliency of the consumer. I feel like I've seen some headlines about credit card balances moving up. How do you get that data in terms of the amount of savings for the average consumer? That seems pretty good when I look at that and say, look at the amount of savings most people have.
Right, yeah. So this data essentially comes out from the BEA, Bureau of Economic Analysis, that looks at,
Okay.
different pockets of GDP and what you're seeing there. And you're right, we were also, keeping an eye on delinquency rates and credit card spending, that because that's probably the first place where signs of stress begin to show in the
Hmm.
consumer, right?
Hmm.
And surprisingly, you're not seeing as much of a pickup there. So delinquency rates, they have risen somewhat as interest rates began to rise, but they're still well below pre-pandemic levels. And we are seeing, maybe consumption has shifted in a way that people are moving away from, you know, expensive products to the cheaper substitutes for those, but you're not really seeing a cut down in consumption at this point of time, which is why if you look at the Q2 GDP data that came out for the US, it was at 2.4%. So, well above trend, and also very strong underlying consumption driving that. So we still have quite a resilient consumer out there if you look at the underlying data as well.
Interesting. Yeah.
Yeah. And I would say the second point there, that's the reason why you still have a really resilient underlying economic dynamics, is because housing is quite resilient at this time, right? So one of the most interest rate sensitive sectors is housing. And you would expect that as interest rates rise, housing should start to see that deceleration. We did see some of that, but not a whole lot. And one of the main reasons for that is the structurally low supply of housing for decades almost. And that's helped keep housing prices up quite some level. The chart in the middle there essentially looks at, what's the impact on prices just from housing supply itself. And what it shows you is that housing supply constraint has essentially helped keep home prices rising. And so if you offset that with the impact of interest rates, net net, housing prices have not fallen by as much. So that's a huge sort of factor pushing economic activity in the US. And the third and the last factor for the resilience is wage growth, right? So we are still growing, seeing wage growth at twice the rate that we have seen before the pandemic. So if you look at these numbers, for goods producing, private service producing, wage growth was close to 2.53% before the pandemic, and now we have that running at 4.5 to 4.6%. So still quite a high elevated pace, which means that it's going to be, a much more resilient consumer as we head into the second half of this year, which is why our growth projections have moved up.
Yeah, I mean, just three very interesting points on the slide. Maybe I'll just mention, because some folks may be listening to the audio later as I, upload this as a podcast. I'd encourage you. We will post this on my blog with the actual slides that you'll be able to see. But these 3 points, I never would have guessed there's that much excess savings in terms of, putting my financial planner hat on, working with people. We talk about have some emergency reserves in the bank, have different pots you can go to, maybe home equity line, maybe credit cards, and then in your portfolio have safe money. So that's encouraging. The real estate home price graph in the middle, boy, we've had a lot of conversations about that. People want to know what's happening with their home prices, what might happen, how that's going to unfold. A lot of people, moving to that empty nester phase, kids off to college, think about the next place or changing residency. We've talked about that. Here in Minnesota, you talked about Madison being cold in the winter. You should try Minneapolis.
Yeah.
It's another level down in terms of coldness, and so we have a lot of people that, for both weather and taxes and things like that, are looking at relocating to Florida or Texas or Nevada, one of the warm weather states and friendly tax climates. So that's very interesting, seeing that resiliency. I would imagine there's going to be pockets that have been very driven up and overheated that might see a sharper fall. But that wage growth you mentioned, I mean, just offhand, double what you expect as a trend line. Very
Right.
interesting. Even with, we heard about some large tech company layoffs earlier this year. It seems there's a thought that there'll probably be more of that, if we do get your scenario of a slowdown or recession. But
Yeah. I think the tech layoff wave has been quite interesting to observe, right? Because once it started to happen, many thought it was the first domino to fall in the labor market strength. But what really happened was, these are essentially people who were losing jobs at a skill level that was still in high demand. And so
Hmm.
you've seen all of those people who'd lost their jobs being reabsorbed into the job market fairly quickly, given
Okay.
the supply constraints. And so we haven't really seen as much of a spillover in any other place. The labor market is still running, upward, if not, averaging 200,000. You've seen some weaker numbers now. But I think, the all data points to a much more resilient labor market than we would have expected with 5% or above interest rates at this point for sure. And I think this does raise the concern about, inflation going forward, right? If you think about the wage growth angle, um, wage growth of about 3% is commensurate with 2% inflation. If you have 2% inflation, labor productivity is about 1%, that adds up to about 3% wage growth. We're still running well above that to some extent. And that does raise the point of like, can we get inflation back then from 3 to 2% that easily? And that's when we come to this next slide of inflation and what's running inflation, right? So I think what's helpful to think about, this is the second section of policy rates and inflation and interest rates. Let's first think about what's driving inflation at this point. So we think that some of the early wins we saw with inflation falling quickly was all of this temporary. Well, I guess temporary would be the wrong word here, but all the disruption that supply chains have caused essentially unwound its way as we went from late 2022 into this year. So case in point being used car again, where you had month on month gains of about 40% in certain months. Now that's fallen back to like minus 2%. And so that's really helped lower some of the more acyclical components of inflation. So if you look at the chart here on your left hand side, the light blue shaded area has now fallen quite significantly. But what's not moved a lot is the cyclical component of inflation. This is tied very intimately with the labor markets and what's happening there. And so, in order to see that part of inflation fall, you'll have to see a weakening in the labor markets. And that comes back, Scott, to your point of like, how do we see that situation turning around? I think we're still in a very tight labor market, right? So if you look at the chart here with job openings to unemployed ratio, that ratio has been hovering around 1.6, 1.8 for the whole of this year almost. What that essentially means is for every one person looking out for a job, there are potentially two jobs out there. So you have high labor demand, low supply, and what that ultimately does is pushes up wage growth. I'm not complaining about that, I'm sure. But what it ultimately is connected with is core inflation. So as long as wage inflation is running quite hot, core inflation will also follow suit.
That
Now, in
makes
our yeah, absolutely. And I think in our forecast, we do see this trend sort of slowing down, right? So we expect that labor markets will essentially slow down as we head into the second half of this year. And we see unemployment rates rising to maybe closer to 4 and 4.5% by the end of this year. And that should help lower the wage growth story from this point onwards. Uh, which is I think an important factor for the Fed to essentially change its stance, right? So if we look at the Federal Reserve and how it operates, one of the main or the top criteria in Fed's decision making is inflation. So if you look at the pie chart here on the left hand side, we did a historical analysis of what drives Fed decisions and what is the most important factor in driving those. So there are a plethora of factors that drive it, right? Inflation, labor markets, financial conditions, as well as global conditions. But by far the top priority, with about 42% weight in Fed decisions here, was inflation. And so as long as inflation remains persistently high, the Fed will not be afraid to push the buttons of the economy as the economy slows and gets even into a shallow recession to get inflation back under control. Point being, we still expect the Fed to be quite hawkish as we head into next year, as long as it's comfortable that inflation is moving in the right direction. Going forward, we expect the Fed to only start cutting rates as we head into the later part of 2024. And by that time, we expect that the wage growth numbers, as well as the labor market, has slowed down enough to get back to a level that's commensurate with 2% inflation. And so this brings me to the third section, that we talked about, right? Recession risks. So, of course, you're talking about the economy slowing down, labor market is cracking, policy is probably going to get less hawkish next year. But when is this actual recession coming, right? So, we expect that recession timeline to be somewhere around later part of 2024. That's when we expect the economic activity to have slowed. But at the same time, we expect this to be a much more shallow recession. There are a couple of reasons behind that. One of them is we are now in a structurally low labor supply environment. So even as you see unemployment rates rise, they will not rise as much as they have done in past recessions because there is still that latent labor demand out there. And the second factor is we think the Fed might somewhat be successful in lowering inflation without as much pain in the economy this time around, given this underlying dynamics. Another way that we have sort of looked into this is, of course, if you look through history, this chart here shows you federal funds rate along with core CPI, and we find that periods when federal funds rate is significantly above or somewhat above core CPI for a sustained period of time are usually followed by a recession. We have sort of, now gotten into that territory since maybe some part of this year, and that's when recession risks in our view have also historically risen. So one more marker apart from the inversion of the yield curve, etc., to sort of look at when we think about recession risk going forward.
And I mean, and that was the design, that was the whole idea, right? The putting the foot on the brakes of the economy, raising federal funds rate, the cost of borrowing, higher incentive to keep money sitting in the bank, slow down the economy to cool inflation. So
Exactly. Yeah, that's exactly right, Scott. And that essentially brings me also to a conclusion, right? We discussed earlier on in today's discussion that inflation uncertainty is probably the most harmful thing for an economy going forward. So the Fed is going to do everything in its power to get inflation predictably and sustainably towards its target. And for that reason, policy will remain quite hawkish as we head into second half of this year and early next year. However, even as that inflation falls, it's going to come at a cost of slowing growth. So, of course, there's no doubt, our forecasts say inflation will get back to 2% by the end of next year, but that's going to happen probably with a weakening labor market going forward. And as the wage growth story also begins to decline, that's essentially when we see a recession most likely in our scenarios. Now, in the conclusion, let me also maybe touch upon some of the risks here, right? So, there's an upside risk. Many have referred to this as a soft landing, which is basically painless disinflation, right? You got from 9 to 3% without any change in unemployment rates. What's to say you get from 3 to 2% as well with that? So there is a certain risk of that. It will probably be the first time in history that it happens. But the current resilience in the US economy has increased that probability. And the downside risk is that you continue to see more inflation upside shocks, which pushes the Fed to do even more going forward, pushing the economy into a deeper recession as well. So I'll close off here and pass it over to Ryan to go through the investment outlook.
well, thank you very much. You helped us. You gave us a tour of a tremendous amount of data and big picture of what's going on. So very interesting to tie together. You see headlines, bits, pieces, and to pull it all together into a concise roundup like that was very, very helpful. And now, Ryan, you have some thoughts for us in terms of what this all means. What's the application? What should we be thinking about with portfolios and investing given these conditions?
Oh, I do, Scott. It's all we've been thinking about lately. Uh,
Okay,
yeah, I also like to say thanks so much for having us here. Delighted to be here. Looking forward to discussing the outlook with you all. You guys can see my screen okay?
got it.
Great. So, as we've all seen with the Savary, there's been a lot happening in the economy recently. And in the second half of this talk, what we want to do is link what's been happening in the macroeconomy and with the Fed policy to our capital markets outlook and what that will ultimately mean for investors. So, from our perspective, as you may see from the title here, the most attractive asset classes at the moment are fixed income and international equities. And we will discuss in detail why. But market volatility from the Fed's hiking cycle will persist, at least in the short term. And that will be an important consideration for investors as they navigate these choppier waters. We should expect continued volatility and market turbulence, but for long-term investors, we want to emphasize the importance of looking past the hiking cycle itself in order to position them for long-term investment success. So let's go ahead and start with fixed income. So what do all these Fed rate hikes imply for long-term investors? So when interest rates rise, bond prices will fall because the present value of future coupon payments declines. And while that can be very painful for investors who own a fixed income at the onset of the hiking cycle, I'm talking like end of December 2021 there. Uh, Although that can be painful in the short term, long term, all investors are going to win. So in general, we can say that higher rates are good for all investors when it comes to fixed income. Over time, however, those rising coupon rates will offset those initial principal losses that some investors will suffer, and that did suffer in 2021. And the amount of time it'll take those investors to have those coupon payments compensate them for the lost principal, we call that Macaulay duration. And for something like the aggregate bond index, we would expect that to take around 7 years or so. So here in this chart, you can see the expected fixed income returns for an investor who owned the aggregate index as of December 2021. And you can see that here we've kind of painted the range of returns we'd expect an investor to see based on simulations from our model, and those returns are positive. Whereas investors who were to uh, enter the market after these hikes had started, so sometimes say late June, uh, even better outcomes ahead in terms of expected returns from fixed income. So none of this means, though, that investors won't suffer some more short-term losses. Sabri did mention that we are seeing anywhere from 1 to 3 more rate hikes possible with the Fed, and nor are they going to be guaranteed long-term profits. But there are ways to hedge against this risk by using, you can calibrate using different duration fixed income to your investment horizon.
And maybe Ryan, just to play interpreter a little
Of
bit,
course,
the rising interest rates, we often talk about this teeter-totter type effect. When interest rates go up because we're still concerned about inflation, still trying to get that under control, that puts downward pressure on the prices of existing bonds
right.
people own, because hey, there's alternative out there paying a higher interest rate now. Why would I want your bond that pays 2.5% or something? So the value goes down. But you're talking about over the long haul, if a bond investor is structured in such a way where they're reinvesting in newer bonds, it does look attractive because they're going to be paying a higher interest rate going forward. And use this, maybe just one other bit, this term duration, very interesting calculation. There's a couple different ways, even throughout Macaulay duration, that to dust off the textbook, but it's a measure of the interest rate sensitivity of the bonds, right? That investor has. So the credit quality of the bond, how long they're lending the money out, there's a variety of different factors there that can play into how much that bond reacts to a rise or a decrease in interest rates.
Absolutely. And Scott, that was a beautiful way of recapping it. Yes,
Okay.
exactly right.
Yeah. Thanks,
And
Ryan.
yeah, of course. And I would say that despite any short-term pain that may come about from those further rate hikes, eventually we do expect the Fed to start cutting. So investors that get into fixed income now are likely to benefit in a couple of years or so when we start seeing the Fed unwind some of those hikes back down to the neutral rate of interest, which our research suggests may be anywhere from 2.5–3%. So that neutral rate is the rate at which monetary policy is neither expanding nor contracting the economy. It's just allowing. It's like the Goldilocks rate. So there is upside there, and we are likely to be in the era of sound money from here on out, meaning that fixed income is likely to maintain its position in investors' portfolios.
You talk about Goldilocks rate, applying that to everyday investors, especially those eyeing retirement.
Right.
This widely talked about kind of rule of thumb of a 4% safe withdrawal rate, 4.5%. Now, I think it's very interesting. It's a quick back of the envelope calculation. There's some flaws. We prefer a more detailed type model, but nonetheless, it does give you a general idea. And I think one of the things that's very interesting, you talk about Goldilocks, Ryan, is we can now in retiree portfolios or those approaching retiree, that 40% of the portfolio, whatever it may be, give or take, that we would dedicate towards fixed income and bonds, or we'll buy those bonds that are paying 4% yield or more and lock those in. to help meet that retirement distribution flow, as opposed to for so many years saying, well, the rates may rise and this is the dry powder in your portfolio for when stocks go down. But now they're really going to be playing a significant role in portfolios, especially for retirees.
Absolutely. It's great to lock in those long-term rates at where they are now. And even nice that things like money market funds now, short-term withdraw anytime you want, they're offering an excess of 5% in some cases. At least the one I own at Vanguard does. So yeah, these higher rates should ultimately be good for all investors.
Right.
But what about the equity markets? So there's a lot to talk about here. The key metric from a 10-year long-term investment perspective is valuation. So that's the price to earnings ratio is typically how we think about valuing different companies. And at the moment, we see that many US firms are in fact overvalued, especially growth stocks. But it's important to remember that valuation in and of itself is not a timing tool. Stocks can be persistently overvalued or undervalued for a long time, as we saw from the most recent decade. And although the Fed's hiking cycle, with high inflation, recession risks, although they have reduced valuations somewhat from where they were in 2020, we're still seeing pretty lofty valuations. And here in this chart, we track those valuations. Instead of using the PE ratio, we use one that's a little more sophisticated called the CAPE, which is cyclically adjusted price to earnings ratio. It's just a PE, but we control for the level of inflation and interest rates. It's a little more accurate in our opinion. And as of June 30th, when we last updated the model, we can see that the CAPE ratio suggests that the market for US is overvalued by about 35% or so. So although valuation is, and this is 35% relative to our fair value, which we plot as the shaded blue line here. This is where we estimate valuations should be, and that is time varying. We're not stuck to one particular number for all of history. We do recognize that the quality of U.S. stocks can change over time. But although I said valuation's not a timing tool, whenever you have valuations get this high, it does imply that the market can be vulnerable, and the probability of a correction remains high. So it is likely to be the case that even though we've given some valuation back, there's likely to be continued volatility in the equity markets. So since we're on the topic of valuations, what do we think about value stocks? Can we expect the return of the value factor? And the answer is yes, we think so. Uh, Growth stocks flourished over the last decade because of two factors in particular. One was there was very low inflation, and the other one is there was very low real interest rates. So money was very cheap. You had a whole lot of venture capitalists just throwing cash all over the place. Investors were very patient, had very long horizons for where they expected returns. But with the Fed's rate hiking cycle in place, we see the potential for this era of sound money to persist into the future. So no longer the era of free money, but now money's going to cost something in order to borrow it. And our Vanguard research indicates that we think the neutral rate is around that 2.5%, 3% mark, which indicates that long-term rates are likely to continue to remain positive as policy normalizes. It's unlikely we're going to be heading back to zero anytime soon. So this, whenever rates are very, very low, that bodes well for growth stocks. But when they're higher, value stocks usually have a little more skin in the game. And over the next,
I'm sorry.
not at all.
Can't resist throwing a thought in here.
Of course.
Comment, and this is something we've been talking about a lot for a long time. Spent a lot of time looking at this in 2019. It felt like there's a overvaluation in growth stocks, and
Yes.
then COVID happened, stay-at-home economy, and it went even further. With technology stocks getting a real boost. Last year, 2022, things really turned with rising interest rates, right? Growth stocks took a punishing hit. But, I think it reminds me of the saying that, you can drown in crossing a river that's 12 inches deep on average. Your last slide, you're saying the US markets are overvalued by a bit on average, but it really depends where you're looking in that spread of stocks. And that's what you're talking about here is just very broadly. Analysts consider certain companies growth stocks. They're taking their excess earnings, they're plowing them into research and development and capturing market share. It's about the future. Value stocks, how would you describe them, Ryan? They tend to often be more stable, more mature industries, but
Higher dividends, absolutely.
high dividends. But I mean, really critically, where they're being traded at, that share price as it's floating around the market. When you look at the value, whether it's the book value or different valuations of the company, it looks like it's a good deal to buy.
Right.
They look relatively cheap as opposed to these growth stocks. So if we split the market in half, we have growth companies, value companies, but even within that, some of the numbers I've been seeing is it's such a tight concentration of really the big technology focused companies on
Right.
the side of the spectrum, the ones that have exposure to or doing things around artificial intelligence have gotten this tremendous lift recently. So I'll try and get out of the way here, but I couldn't resist flowing it. I think this is really critical that there are attractive companies, there are bargains to be had. What's driving those numbers? It's like we'd say, hey, on average, the four of us are overweight, but then when we look a little closer, it's, hey, Scott, you really need to go on a diet. The other three look really good, right? So it's the averages can be skewed by tight concentration.
Exactly. It's easy to forget that with the last decade of growth so trumping value, that value actually has outperformed growth historically, and it's what made Warren Buffett all of his money. So it definitely does deserve its place going forward. And that's what our models tell us is that our expected median return for value relative to growth, so how much we expect value to outperform growth by, we see the median return there being about 4 percentage points or so. And
And
yeah,
I'm sorry to jump in again, but I mean,
I
I
love it.
shared this piece with a client just in the last week or so, talking about this exact thing: recent domination of growth stocks. But
Right.
two different. I mean, if you go way back to like the 20s or the turn of the century, I mean, it has historically been over a 4% spread of value
Right.
stocks performing growth stocks. It's an amazing. But there's just something about it. The growth stocks are always the darlings. They're the exciting
They
companies.
are the
They're the
Teslas, the
flashing companies.
Zooms.
Yeah, they're the ones doing cool, exciting things, but you can overpay for cool and exciting stuff, right? And that's
Yes.
part of the problem there. Yeah.
Yeah. I owned a lot of growth stocks before the crash started happening. And yes, it can be a painful lesson to have to give back those large gains. Got to be
Yeah.
prepared to hold them for the long term. Um, the rationale here, though, as far as like why do we expect the value to start outperforming is that, well, it's the valuation is so low relative to growth companies that if you look at this chart on the left here, those three lines that we have kind of fanning out to the right, that is sort of like where we believe the fair value of value stocks relative to growth stocks is, and the dark green line we have there is well below that. So as which is the actual ratio of value stocks value to growth stocks value, and as that converges back to fair value, we see that being about a 4% per year uh, net return over the next 10 years. And over the next 5 years in particular, we're really going strong on value here, anticipating a median return of 10 percentage points relative to growth over the next 5 years as we get that sort of that mean reversion happening here.
Wow.
Yeah. And it's true. Like there's one caveat here, which is that value stocks did really well from like the end of 2020 through the end of 2022, and but growth stocks have been outperforming quite well over year to date 2023. And while it's great to get some of those returns back, it does reinforce the valuation discrepancy we have here, meaning that going forward, it really does brighten our outlook for value relative to growth.
Yep. Very interesting.
Of course. But now for the other topic that people love. So, international equities. So, given the importance of valuation for our 10-year outlook, our research strongly has endorsed looking beyond the US for returns. And when we've made this call about international in the past, like, this is like the bane for most financial advisors, as I'm sure you'd agree, Scott. We haven't gotten this call right. But we have been able to use where we went wrong as a learning opportunity to help us strengthen our forecast going forward. And believe me, we've done our very best there. We understand though that it's hard to advocate for international equities when U.S. has done so incredibly well over the last decade. And we're not saying that investors should not continue holding U.S., but going forward, we're going to advocate that it's important to hold a bit of a balance, to rely on international for more of that diversification benefit. It's like, eating your vegetables at dinner.
Yep.
So before we talk about the outlook going forward, let's talk about, it's useful to think about why the US did outperform international so well. about 10 percentage points per year over the last decade. And first, there was significant valuation expansion among US equities, which contributed about 4 percentage points to that 10% outperformance. Second, the US had remarkably strong earnings growth, and international firms, on the other hand, underperformed their historical earnings growth by about 50%. And third, US dollar has just been on a tear with appreciation. It's appreciated significantly over the last decade, and that hurts international returns for a US based investor, and that contributed another 3% to that 10% outperformance. So, given all of that, why are we bullish on international going forward? Well, first, if we talk about valuations, it's extremely unlikely that we could continue to see similar U.S. Valuation expansion going forward. We're talking like the 95th percentile of our expectations would have to persist over the next 10 years. Eventually, expanding valuations, when they get really lofty, they collapse under pressure to continually exceed a higher and higher bar. I mean, think of the Teslas and their earning expectations. You can only drive higher, so many times by uh, outperforming on valuation. And I'll show you on the next slide what we think about the valuation of international equities. But the second thing is that although US earnings growth and especially profit margins were outstanding, we do believe that they have reached their peak, and we've reached this conclusion using some proprietary earnings growth models that we have. And we're looking at earnings growth in the US to be about 5% annualized over the next 10 years, which will marginally outpace international. And then finally, we're going to expect foreign exchange to play a much more helpful role for international than it has in the past. So I mentioned that there was appreciation of the dollar over the last 10 years, and that appreciation occurred in part because one of the desire to invest in the U.S. tech sector, but looking forward, more recently, as the Fed has been faster at hiking rates, once policy normalizes in the U.S., then we're going to start to see some depreciationary pressures on the dollar, which should help international returns. So if we kind of look at these four components together, valuation expansion in international relative to US will help. Earnings growth will offset some of that, but then by and large, it's the dividend yields from international and the depreciating dollar that we see making a strong case for international, giving a median return of 7.4% relative to the US at about 4.7%. And this is helped even more by the year-to-date rally we've seen in US stocks relative to international. So overall, I'd say that we're estimating international to outperform the US about 70 to 80% of the time, judging by the simulations that we run with our models. And with profit margins and earnings and valuations at all-time highs, even if the US were to outperform again, it would likely be by a much thinner margin than what happened over the last decade. So we will therefore, as I will show you, recommend that investors diversify and hold both US and international in their portfolio.
If I can ask a quick,
Absolutely.
A few moments ago, we were talking about U.S. stocks and the difference between growth and value. Are you seeing
Right.
that same type of dynamic in international stocks? Are you favoring value stocks, or is this more of a blanket statement?
It's more of a broad, within international, you could get specific, but as far as the international ex-US market as a whole, whether you look at developed market or you look at emerging markets, they're all very attractively valued from a valuation standpoint. And Scott,
Got
that's
it.
a good point. I should mention over the last 12 months, I had the numbers here somewhere, but US performed like something like international, whether you did total international or just developed market, was outperforming the US over the last 12 months by anywhere from 2 to 4%. So we are starting to see this thesis come to life a bit, but growth stocks have had some resurgence, which is carrying the US performance year to date.
Yeah. My other question, and I don't know if
Sure.
I'm going to get you pinned down on this one or not,
Not
but I
at
find
all.
it interesting. Vanguard is very commonly associated with index or passive approach to investing. Say, hey, let's
Right.
not try and pick winners and avoid losers. Let's just buy large blocks of the market. And that's a wonderful way to get market exposure for many people or in many parts of the portfolio. But I find what a lot of people don't know is Vanguard is actually a huge active investment manager as well, right? And so sometimes it comes a question of, is it active investing, or is it passive or index investing, but maybe where or how much of each of these different types of strategies. something I've seen over the years is that if you were to lean towards an active approach, it might make more sense to do that in international markets versus US markets. More active managers have outperformed than in the US market, and they tend to do so by a bit wider margin. Is that, do you have an official line or thoughts to share on that? Is that consistent with your findings or not?
Well, Scott, we do have an entire team here that looks at active and passive indexing, and they have written a ton of research on the subject. I am probably not in a position where I could succinctly sum up their findings in a way I'd like to. Asavri, do you have anything you want to add here?
Yeah, Scott, I think that's a great question, and we can maybe provide some links on some of their more recent research on those topics, and maybe they can be shared, I guess, as well, like extensively. So,
Yeah,
John, we can also um, you know get back to you on those links. But
would be a
like,
good follow-up. Yeah, okay,
Yeah.
yeah, of course, yeah. Brian mentioned we do have a team that works specifically on that. So.
great, thanks.
And Vanguard does believe there's a position, a place for active in a portfolio. Yeah, I just don't want to give an answer that I can't be totally sure of. So
Got it.
thank you. I want to be sensitive to our time, Scott. So I'll try to be a little more brief with these other points. If we take a bird's eye view of valuations and where they're sitting among different factors, there's a few things we can call out. So, looking at equity markets on the left, US growth is overvalued relative to the US stock market as a whole. We're not so fond of growth at the moment, whereas small caps are pretty attractively valued, although it is worth keeping in mind that small caps tend to be very procyclical. They move with the macroeconomy and they can be quite volatile as well. So something to consider from a risk standpoint is you might not want to necessarily go too far in to small caps. But if you look at like the lower half of this yellow bar here, where we're kind of arguing things are fairly valued, um, both emerging markets, ex-US developed markets, and value stocks in the US, those are looking pretty good to us from an equity standpoint. And if we look over at the bond market, high yield credit, we're not so fond of it, is pretty highly valued. We prefer investment grade instead, but treasuries are a great deal right now, and the aggregate index is looking attractive. And I'm going to come back to the portfolio view of this, but one question, Scott, I'm sure you and all your advisors have gotten is about this 60/40 portfolio. Is it dead? And the main motivation investors have for holding 60/40 is they want to exploit the negative correlation between stocks and bonds. And we think that the inflation is not going to upset that correlation because historically the correlation's been typically negative. It's not unusual though for there to be brief periods in history where it turns positive. And although it's positive right now, we expect that positivity to convert to zero correlation within the next few months. Coming back though, Scott, to your question for Savri about the importance of a 2% inflation target, we've done research on the correlation and we found that the correlation is only likely to be meaningfully positive if inflation is really high. So our research shows that for the correlation to be positive and to stay positive, the Fed we would have to have 3% annualized inflation uh, over a 10-year period. So what that would mean is the next 3 years would have to have annualized inflation of 4.5% for us to get into that danger zone of this positive stock bond correlation. And with headline CPI being like 3.2% and core being 4.7, like if the Fed succeeds at bringing down inflation, then 60/40 investors aren't going to have anything to worry about.
Mhm. Right.
Um, yeah. So if we look more broadly at 60/40, it's really going to be a good tool going forward. And it has been a great tool in the past because now diversification is going to matter when you have this uncertainty about attractive aspects of international, potential risk in the US. And we're going to show that investors can get really good returns holding both of these to different proportions. And looking over the next 10 years, we're expecting the 60/40 to return something like 5.7% annualized. Um, and I'll say this about the 60/40. It's important to keep in mind a couple things. One is that these higher interest rates in the economy are going to make bonds important for investors' portfolios, especially if the Fed starts cutting later on. And second, the likelihood of international performance, is a real fact, and it will be important from that diversification perspective to maintain exposure to both U.S. and international quite more so than it has in the past, where it may have very well served an investor better to just be overweight US. But tying this
Yeah.
all together in the go for it, Scott.
Oh, I was just going to say, yep, great point. I think that's one we'll probably spend some more time on with clients. And of
Of
course,
course.
60-40, 60% stock, 40% bond.
Right.
What are the stocks in that 60%? What are the bonds? It's like saying, do you want a turkey sandwich? There's a lot of different types of bread or ingredients or types of cheese that can go in there that
Absolutely.
outcome.
Absolutely. And the quintessential 60-40 that at least Vanguard would offer something like this in their target date retirement funds is you have that 60% US equities, 40% international, and then of the 40% of that's bonds, it's again 60-40 US international. 5.7% annualized return expected, 9.7% expected annualized volatility. But if we were to tie together all the lessons we've kind of learned from our research so far, if you were to ever have an investor who is willing to take on some active risk and some modeling risk, well, there's a couple things that can happen here. One is that you can lean more heavily towards international. So instead of doing the 60-40 US to international stocks, you would do 40-60, being overweight international. And at the same time, because of the attractiveness of the higher interest rates in US fixed income in general, leaning more heavily in a portfolio instead of doing 60-40, maybe doing like 45-50, 55, where that 55% is more fixed income, we do see a way for investors to achieve a similar return as a 60-40, like a 5.8% annualized return over the next 10 years, while having lower volatility that you get from that greater share of bonds in your portfolio. So we do think that there's a role here for more international and fixed income. And that'd be our takeaway for clients is that diversification is likely to matter now going forward, more so perhaps than it has in the last 10 years, at least as far as equity is concerned. And fixed income has frankly not been this attractive in a long time.
Great news. All right. Did you have anything else for us, Ryan?
That is everything, Scott.
Okay. Well, hey, Iswari, John, Ryan, this has been great. I really appreciate your time. Appreciate you fielding all my questions here and putting this material together for us. So just to, kind of recap for anyone who might be listening or viewing, general discussion, seek your own advice. We will post this. I'll post this in my blog, scottoeth.com. We'll share it with clients individually. But this has been a fantastic discussion and very interesting to see what you're coming up with on the research side. Appreciate your time.
Thank you, Scott. Great being
Thank
here.
you, Scott.
Thanks for having us, Scott. Take care.
You as well. Bye.